Hi everyone, this is Professor Gallagher. In Chapter 6, we're going to discuss self-employed business income and the Schedule C that our self-employed business income is filed on. A trade or business, as defined by the IRS, is any activity that is engaged in for profit. Self-employment income is reported on the Schedule C when preparing a taxpayer's tax return. The gross receipts that will be reported on the Schedule C include direct sales to customers, work performed as an independent contractor, and any amounts that are reported to a statutory employee. Independent contractors will usually receive a 1099 miscellaneous to report income. The accrual method of accounting must be used for a self-employed individual if inventory is a material income producing factor. However, if gross receipts for the last 3 years is under $25 million, then the cash basis of accounting can be used. Business expenses are deductible, but however, to be deductible, the expenses must be ordinary, meaning that they are expenses that are customary or usual in that course of business. Necessary, meaning that they are appropriate and helpful rather than essential, and reasonable, meaning that they are reasonable in amount and reasonable in relation to their purpose. There are certain expenses that are forbidden to be deducted as business expenses, and those include bribes, kickbacks, and other illegal payments, lobbying and political expenses, and any fines and penalty payments. These are not deductible even if they are considered to be ordinary, necessary, and reasonable. So let's take a look at an example. We have Atlas. He's a financial consultant, and he had the following income and expenses in his business. He took in $235,000 in fee income. He had $18,000 in business rent expense. There was $2,500 in penalties assessed by the SEC. He had $6,000 in office expenses, $6,000 in supplies, $2,700 on interest on a note that was used to acquire office equipment, and $650 for speeding tickets when he was going to visit clients. So which of these expenses would be considered proper business expenses? Well, we know we can claim his rent. We're not going to be able to claim his penalty. The office expenses would be considered claimable. Office supplies are allowable, and interest paid is allowable, but the speeding ticket is not going to be allowed. So his net income from his business is going to be his fee income minus rent, minus his office supplies, his office expenses, and his interest on the note. So his net income would total $202,300. So next, depreciation is an allowable business expense. There are 4 different components of depreciation: the basis, which is the cost of the asset; the depreciation period, which is based on the asset class lives; the depreciation convention, which is half year, mid-quarter, or mid-month; and the depreciation method. This is reported on Schedule C, Schedule E, and Form 2106. The basis of the asset is going to be the cost of the asset. If a personal asset is transferred to a business, the basis will be the lesser value of the fair market value or cost. If there is an asset that is transferred to a business using a non-taxable exchange, the basis will be the cost less any deferred gain. We'll talk about non-taxable exchanges later in the course. If the property is inherited, the basis is going to be the fair market value at the date of the death. The typical depreciation periods are 3 years, 5 years, 7 years, 27.5 years for residential real estate property, and 39 for non-residential real estate property. For this course, you'll need to mostly know the 5-7 27.5, and 39 year. So let's take a look at a couple examples. We have an automobile that was used in a trade or business that would be depreciated over what period of time for maker's tax purposes? Well, a automobile is going to be classified as a 5-year property if we go back to our depreciation periods. An apartment complex would be depreciated over what time period for maker's tax purposes? Since that is a residential property, that would be 27.5 years. The depreciation conventions that are used are the half-year convention, mid-quarter convention, and mid-month convention. In the year of disposal, the convention is going to be the same in the year of disposal. So the conventions mean when we are calculating depreciation, if we're using the half-year convention, the asset is treated as being placed into use in the middle of the year. If it's the mid-quarter, it would be considered the middle of the quarter, and mid-month, the asset would be placed into service in the middle of the month. So we have a couple questions to go through. A taxpayer can choose any depreciation convention as long as he or she is consistent in doing so. False. There are specific guidelines for depreciation conventions set by the IRS, and a taxpayer must use the mid-quarter convention for personal property if more than 40% of the property is purchased in the fourth quarter. This is true if a taxpayer purchases more than 40% of the assets that are being placed into service in the fourth quarter, then the taxpayer would need to use the mid-quarter convention for that tax year instead of the mid-year convention. The depreciation methods that are used for tax purposes are the 200% declining balance switching to straight line, the 150% declining balance switching to straight line, and straight line. Straight line is going to be used for all buildings, all real property, and other business assets would be depreciated using the 200% declining balance method. But we're going to use the depreciation tables that are in our textbook for calculating depreciation. Under Section 179, taxpayers are allowed to write off a certain amount of expenses in the year without deducting it over several years under normal maker's depreciation. For 2017, the maximum limit was $510,000. For 2018, that maximum amount was extended significantly to $1 million. However, claiming the upfront Section 179 depreciation deduction expense cannot create a net operating loss. Let's take a look at an example. We have a taxpayer who purchased a piece of business equipment for $12,000 on May 3rd, 2018. The equipment is the only business asset that was purchased during the year, and the business has substantial income. What is SHU's deduction for the equipment, assuming the 179 deduction is elected? Would there be any additional maker's expense, regular depreciation? Since they have substantial income, we're assuming that they have more than $12,000 of income. So if that is the case, then the total purchase of that business equipment for $12,000 would be able to be expensed under Section 179. So that means that there would be no additional maker's depreciation on that asset. However, if the business income was, let's say, only $8,000, then the Section 179 expense deduction would be limited to the business income of $8,000, which would give us additional depreciation that would need to be calculated for $4,000 of that asset. There is also 100% bonus depreciation, and this is on makers' property with less than 20-year lives. And this applies to property that's acquired and placed into service prior to December 31st, 2023. This reduces down to 0% over the 5 years from 2024 to 27. This means that the assets are fully deductible, and there are no other limits other than the luxury automobile limits, which we'll discuss in a few slides. So this lessens the importance of Section 179 because as bonus depreciation, we can go ahead and fully deduct that asset anyway. This is a change from 2017, in which the bonus depreciation was only 50%. Listed property refers to assets that have both a business and a personal use component to them. Some examples of these would be automobiles and boats. Section 179 is not allowed if listed property is used for less than 50% for business. If it is used for less than 50% for business, straight line depreciation is required for listed property. So there are luxury automobile limitations put into place for depreciation. This kind of dissuades business owners from buying really expensive cars for business use. The limitation for automobiles for less than 6,000 pounds for the first year is 18,000. The second year is 16, third year 9,600, and fourth year and after is 5,760. So this limits the amount of depreciation that can be taken on a luxury automobile. With an SUV that's greater than 600 pounds, Section 179 is going to be limited to 25,000, and the 100% bonus depreciation is not included in this limitation. For purposes of this class, I just want you to know that there are limitations put on depreciation for luxury automobiles. You're not going to need to memorize all of the limits per year for any homework or exam purposes. For leased vehicles, there is a lease inclusion amount that's published by the IRS, and this is included in income when a leased vehicle is over the luxury automobile levels. So there is this amount is published by the IRS in the Revenue Procedure 2018-25. The total business lease amount is deductible.